All right, let's broaden the conversation out and bring in BNY Mellon's head of equities, Alicia Levine, and Merrill and Bank of America Private Bank CIO, Chris Hyzy. It's great to have everybody with us. Alicia, I'll go to you first. It's earnings, it's inflation. Those are the most important things, obviously. You want to react to anything that Mr. Greenhouse has said, and what's your current view of the market where we are here?
Look, I think you just had a great conversation, and in many ways I agree with Dan. The real issue is that, yeah, you can have a rally here into second quarter earnings season, but you're probably going to have a round of cuts coming into that second quarter earnings season. It's pretty clear there's a mismatch of inventory levels and demand patterns all over the supply chain. It can't just be one company. So we're going to see cuts on the discretionary side, some of those big box retailers. And then on top of that, you know, the discussion about peaking inflation is really well taken. We probably have a peaking on the core inflation rate as goods prices come down. Nobody's arguing with that. But what do you do with a headline number that stays at 8% because of energy and food? It still requires the Fed to act and to act hard. And so, you know, it's not enough to say inflation is peaking. We're going to be left with very high headline inflation numbers that the Fed is forced to react to. But if we do have lower numbers sometime in the future, I don't think the Fed pivot is enough to really stabilize the market here, because the earnings for 2023 aren't believable and they have to come down first.
So Chris Hyzy, you make the argument that we're a little more than halfway through a cyclical bear market, but that the secular bull market is actually still intact?
Yeah, I think Dan touched on this a little bit before. You know, earnings are going to have to come down. We know that. The analyst community usually waits a little bit until they have enough conviction to lower them. The market knows this already. It's probably one of the reasons why.
They're waiting for, like, the Jaguars to win the Super Bowl. I mean, what are they waiting for?
Wow. Well, they wait for confirmation from the companies, right? And the companies have yet to fully deteriorate their own earnings, and that's coming. We know that. In terms of the secular bull market, you know, innovation, automation, transfer of technology across the entire energy spectrum, the amount of growth that's going to happen in the next 10 years, we're so focused on Friday's CPI number, and we're not focused enough on what's going to happen in the next 3 to 10 years, which is a resumption of the secular bull market, because earnings are not going away. They're going to get reset. We know that. Multiples happen first, then earnings. The Fed may not come to the rescue this time, but all it takes is a pause once inflation peaks. And I would argue that instead of looking at CPI, we should focus on the Fed's gauge, which is PCE. And that is coming down, not as fast as we want and not to the level they want yet. But that's what ultimately gets them to pause.
Dan Greenhouse, I mean, bear markets, talk about that. I mean, it's price, it's time. Price has corrected a lot in an awful lot of stocks. Time, though, doesn't feel like we've been in a bear market for, if you want to say, long enough, quote unquote. And that sort of flies in the face of some of these predictions that, oh, this was just a correction. This is not a full-fledged bear market because we technically didn't go down full 20%. We went down like 19.
Yeah, I saw this debate with Belsky yesterday.
Yeah.
This is ridiculous. We fell 19.5% instead of 20%, and that's somehow not a bear market. I mean, speaking as an investor, who we have money, like, you know, for a lot of people in technology particularly, but the market in general, this is a bear market. And I would take issue, and I know you would agree, with the idea that it hasn't been long enough. I mean, the unprofitable tech names have been in a bear market for a year and a half. There was a point where 70% of the stock market or something was down 20% from the highs at least. Those are extraordinarily large numbers. And just because recently Apple and Amazon and Google and the like have caught up on the downside doesn't mean, I would argue, that the broader market hasn't been in a bear market for much, much longer than the headline would suggest.
Alicia, where do I want to be positioning right now, given the view of this panel and what we think lies ahead for all of the risks that you suggested are out there?
Look, we do think you probably retest 3,800 and possibly lower over the next few months as the earnings come in. So we're pretty much defensively positioned here. We're very overweight energy. We're overweight healthcare. We're overweight utilities, foods on the staple side. But we also think there is select opportunities on the tech side, even though that feels unpopular right now. We do think actually enterprise in this particular downturn will be less cyclical than in previous cycles just because of how companies have to manage their businesses. We think there's CapEx and the reshoring to America is interesting on the industrial side as well. And we're actually starting to look at financials, believe it or not, because we think that yields have made the big move. And if that's the case, the balance sheets are probably fine. And financials could be an interesting place to start picking up some stocks.